This chart shows the heartbeat of a healthy market, driven by millions of participants making decisions based on available data. For this complex machine to function efficiently, everyone involved has to believe they are playing by the same rules. When those rules are broken, the system breaks down. We call this market abuse, a category of behaviors that destroys market integrity, allowing a privileged few to extract profits at the expense of everyone else. International watchdogs like the International Organization of Securities Commissions don't treat this lightly. They view these behaviors as a direct threat to the systemic stability of entire economies. Market abuse acts as a structural attack on the foundational trust required for global wealth creation. To understand how trust is compromised, we have to examine specific offenses. We start with insider dealing. This occurs when an individual exploits non-public, privileged information to gain a personal advantage in the market. The law requires specific ingredients. First is price-sensitive information, specific, precise data hidden from the public. The threshold rests on impact. If revealed, it would significantly affect the price. The second requirement involves price-affected securities, covering shares, bonds, warrants, and depository receipts. The legal definition has strict boundaries. Commodities and their derivatives, like futures contracts on agricultural goods or energy products, are typically excluded from this specific rulebook. The final ingredient is the inside source. The perpetrator must have gained this information through a specific role, perhaps as a corporate director, an employee, or an external professional auditor working closely with the company. A trade is executed before the rest of the market is allowed to know the truth. Insider dealing relies entirely on information asymmetry, profiting from an illegal head start. Insider dealing relies on hiding the truth. Market manipulation takes a more active approach, manufacturing lies to deceive the public and steer market behavior. Regulators categorize behaviors that distort markets into a broader framework of deceptive trading practices. The first category is improper disclosure and misuse of information. This occurs when an insider leaks corporate secrets or trades on terms not generally available to the public. Manipulating transactions occur when sudden, massive buy orders hit a stock, creating a false impression of demand and forcing prices to artificial highs. In manipulating devices, as legitimate investors rush in, the manipulator pulls their orders. The price collapses, leaving everyday traders with heavy losses. A final method is dissemination and distortion. This involves deliberately spreading false information or misleading rumors about a company to trick the public into altering their investment strategy. Insider dealing exploits what the market doesn't know. Market manipulation actively poisons the very data the market relies on to make rational decisions. Crossing these lines carries severe consequences. Firms caught engaging in or failing to prevent market abuse face massive civil fines or even the permanent termination of their license to trade. While many market abuse offenses are penalized as civil infractions, insider dealing is frequently prosecuted as a criminal act. Individuals found guilty regularly face significant prison sentences. These crimes adapt. As communication methods and trading technologies evolve, perpetrators develop increasingly sophisticated schemes to manipulate data and hide their digital footprints. Authorities have to build and constantly refine new tools. They monitor complex global networks and deploy advanced algorithms to track suspicious trading patterns across international borders. The forensic war against market abuse is a permanent necessity to protect the belief that the system is fair.